Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the week that was, the weekly podcast that sums up market movements and events from the past week and their implications on asset markets. I'm Michelle Castellino, the host for this week's podcast. Last week, markets inched higher. Nifty and Sensex rose by 1.3% and 1.2% respectively. Broader markets witnessed a sharper rise as mid-cap index rose by 3.6%, while the small-cap index rose by 4.3%. The rally was driven by easing crude oil prices, strengthening sentiment around a potential geopolitical de-escalation between the US and Iran, and a recovery in global markets. The broader rally spilled over into cyclical and some defensive sectors as energy rallied 4.6%, real estate rallied 3.6%, capital goods and FMCG were up by close to 3%. Utilities sector saw the highest rise of 5.4% as investors are betting big on power sector companies, expecting a rise in electricity demand ahead of the peak summer season. Bond yields largely remained flat over the last week, with the 10-year G-Sec closing at 6.91%. Gold rose marginally by 0.9% after the US dollar weakened and the US Treasury yields declined following growing optimism about a possible US-Iran peace deal. Crude oil prices rose marginally by 1% after a steep decline in the previous week. Inflation and trade deficit data that came in last week gave us a first real glimpse into how the Middle East conflict is filtering through to the economy. Starting with inflation, March CPI rose marginally to 3.4% year-on-year compared to 3.2% in February 26. Food and beverages inflation came in higher than expected at 3.7%, led by higher prices for meat, fish, fruits and edible oils. On the other hand, vegetables and pulses stayed subdued while cereal prices continued to decline. Energy told a different story. Electricity, gas and other fuel baskets picked up momentum in March, driven by the LPG cylinder price hike linked to the US-Iran conflict. These numbers reflect only a partial pass-through of the current hikes. Petrol and diesel prices meanwhile stayed flat, contained by government intervention. Core inflation remained relatively stable at 3.7%. Decline in jewelry, especially silver and personal care products, helped offset pressures. But the pass-through of higher crude oil prices into airfare and gold is yet to fully play out. Now coming to the trade deficit, March trade deficit narrowed as supply shocks hit oil imports. For FY26, the goods trade deficit widened to $333 billion, with imports up 7.6%, while exports barely grew at 0.9%. Exports in March fell sharply down 7.4% year-on-year to $38.9 billion, dragged by gems and jewelry, pharma and garments. Imports declined 6.5% to $59.6 billion, driven by a 6.1% month-on-month fall in oil imports to $12.2 billion, and a steep 59% drop in gold imports to $3.1 billion. Non-oil, non-gold imports, however, grew modestly at 2.4%. The closure of the Strait of Hormuz hit regional flows hard. Imports from the UAE fell 45% month-on-month and Saudi Arabia by 26%. On the positive side, the services trade surplus improved slightly to $18.2 billion in March, up from $17.8 billion in February. Looking ahead, the US-Iran ceasefire aligns with our CIO's base case of a 4 to 6 week conflict, which should help limit the damage to growth, inflation and trade from elevated energy prices. However, near-term optimism aside, this does not eliminate downside risks. We continue to monitor two risks. First, the negotiation process and whether it leads to a long-lasting agreement. And second, how long oil prices continue to stay high, given that time would also be required to restart production, return to full shipping capacity, and repair the damaged energy infrastructure. That's all for this week. Thank you for listening to our podcast. If you found it useful, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.